The following is a brief educational presentation concerning an alternative investment strategy called Senior Life Settlements. This video was provided for educational purposes only and should not be construed as an active solicitation for any particular life settlement investment. First of all, what is a senior life settlement? A senior life settlement is simply the sale of an unneeded or unwanted life insurance policy by a senior citizen to a third party, typically a licensed life settlement provider. So, what is a senior life settlement provider? A licensed senior life settlement provider is a company that offers the individual investor the opportunity to purchase fractional interest in the eventual death benefit payout of an existing life insurance policy. Transactions like these have created a multi-billion-dollar secondary market for life insurance policies, as well as a new asset class for retail investors. Previously, this investment was only available to institutional investors such as banks, hedge funds, and other insurance companies. A recent study done by the Conning Research Group estimates that life settlement transactions will exceed $21 billion by the year 2012. So, why would someone want to sell their life insurance policy? Well, there are any number of reasons. The premiums on the policy might no longer be affordable. The beneficiary for whom the policy was originally purchased is now deceased or might no longer have a need for the policy. A key man policy, designed to protect a company from the financial loss of a key executive, is no longer necessary because either the business no longer exists or the individual is no longer integral to the business's success. A policyholder owns multiple life insurance policies and wishes to eliminate one. A few more reasons why a senior might want to sell a life insurance policy. The policyholder wishes to replace an individual policy with a survivorship policy, a long-term care policy, or funds for long-term care. The policyholder requires funds to pay for general medical expenses or even for new and experimental treatments for himself or someone close to him. The sale of the policy would allow the policyholder to maintain a desired standard of living throughout the rest of his or her life. A brief history of senior life settlements. In 1911, the Supreme Court declared that a life insurance policy was a transferable and saleable asset, based on the court case Grigsby v. Russell. Because of this landmark case, the secondary market for life insurance policies was born. Prior to this case, any holder of an unneeded or unwanted life insurance policy had only two options. A. Sell the policy back to the life insurance company for pennies on the dollar. B. Simply allow the policy to lapse, forfeiting all premiums paid as well as the eventual payout to the family estate of the policyholder. And believe it or not, 89.5% of all universal life insurance policies are allowed to lapse and never result in a death claim. That's right. According to a study done by Milliman and Robertson, an international actuarial firm recently published in Time magazine. These lapse policies represent approximately $2.2 trillion in potential unclaimed death benefits. Senior Life Settlements offers policyholders a third option, the chance to sell their policy for a lump sum cash payment, turning a death benefit into a living benefit for themselves and their families. Now, let's take a look at the specific benefits of Senior Life Settlements as an investment. Number 1. Often cited as the most persuasive reason for an investor to choose Senior Life Settlements, their value is unrelated to the stock, bond, commodity, and real estate markets. This is probably the single greatest strength of this asset class. No matter what happens in the global economy, life settlement payouts will not be affected. Fact, even during the Great Depression, when the United States banking system ran out of money, domestic life insurance companies paid out on every one of their death benefit claims. Number 2, related to number 1 and similarly persuasive, The value of senior life settlements won't be affected by global economic trends, the political climate, or interest rate fluctuations. Number 3. An investment in senior life settlements is an investment in an asset issued by some of America's strongest, most stable companies, financial giants like New York Life, Prudential, and other highly rated insurers. Number 4. Senior life settlement investments provide true portfolio diversification, specifically because they are not linked to either domestic or international economic trends. Many investors choose to add an additional layer of portfolio diversification by investing in more than one policy at a time, essentially hedging each policy against the others. Number 5. With senior life settlements, no active management is required, so no ongoing management fees are incurred. This is because senior life settlements are a buy and hold investment strategy. Most other strategies require ongoing maintenance and/or management, which ultimately diminish the return to the investor. Number 6. With senior life settlements, each individual investor has direct fractional ownership in the asset, or DFO. In practice, what this means is that each individual investor owns a discrete interest in a particular life insurance policy, and thusly is not relying upon the management of a life settlement provider to generate profits. The investor has purchased an asset with a stated future value at a discount to its face value. The only variable is time, which can be estimated but not controlled. Number 7. Senior life settlements as a buy and hold investment are an excellent choice for investing qualified money, such as IRAs, 401ks, and pension funds. Number 8. Senior life settlements are a defined asset class that is regulated by the State Department of Insurance. Number 9. Compared to normal equity market volatility, senior life settlements provide a preservation of the invested capital over long periods of time. In most cases, the insured individual on the policy must live several years beyond his or her life expectancy before the amount invested exceeds the payout of times. As with any financial instrument, of course, there are risks involved. The first risk associated with an investment in senior life settlements is that, as an asset class, they are not liquid. As was mentioned earlier, senior life settlements are a buy and hold financial strategy. Also, with an investment in senior life settlements, there is always the possibility that a policy can go long, meaning that the insured individual lives past his or her estimated life expectancy. If this happens, what is known as a premium call payment will be required by the insurance carrier to prevent the policy from lapsing. As an investor, the amount of your potential premium call payment will be calculated based upon your percentage of ownership in the policy. At the time your investment is placed, your life settlement specialist will make you aware of the amount of your potential annual premium call payment. In short, if the insured individual lives longer than expected, your returns are lower. Conversely, if the insured individual does not reach his or her estimated life expectancy, the returns are higher. Now that we have briefly discussed the benefits and risks, let's talk about the average return on investment of a senior life settlement. For the educational purposes of this presentation, it is accurate to say this. Over the past 10 years, both the average and median compounded return on investment for senior life settlements as an asset class have been in excess of 10%. The policy that matures earlier than its estimated life expectancy can yield even higher returns. And policies are priced in such a way that in the event of the insured individual exceeding his or her life expectancy by several years, the investment remains profitable, yielding returns that are comparable to a CD or U.S. Treasury. The senior life settlement investment process. So here's how it starts. Somewhere there's a person with an unneeded or unwanted life insurance policy, and this person comes to realize that the policy is a saleable asset. In most cases, this person seeks the counsel of his or her most trusted financial advisor, usually someone like a broker or estate attorney, to help them sell the unwanted policy on the secondary market. This is when the senior life settlement provider enters the picture. The life settlement provider evaluates the policy to make sure it meets the strictest criteria, both for return on investment and investor safety. This step includes verifying that the policy has passed its 2-year contestability period, has been signed off on by all beneficiaries mentioned in the policy, and has been scrutinized thoroughly to verify that no liens or loans are tied to the policy which could affect a timely payout. Did you know Senior life settlement providers only buy policies from highly rated legal reserve life insurance companies. Senior life settlement providers are constantly evaluating a wide array of life insurance policies for investment potential, but only purchase a small percentage of these that meet all their strict criteria. At that time, the chosen policies are then made available to potential investors in the form of direct fractional ownership. And finally, an escrow agent is usually brought in by the senior life settlement provider to fulfill certain vital functions, including closing the transaction, serving as policy custodian, paying the premiums, filing the death claim, and paying out the settlement. When the transaction closes, this escrow agent pays or deducts the following fees and costs, which are included in the acquisition cost. The full payout to the insured individual. Annual premiums allotted to keep the policy in force for the full life expectancy of the insured individual. Escrow agent service fees, and fees payable to the life settlement provider and other brokering agents. And then, when the policy matures, the investor receives a pro rata share of all proceeds paid out by the insurance company, plus a share of any unused premiums held in escrow. At this time, the investor has the option to discuss a plan for reinvestment with his or her senior life settlement advisor. Advisors in the financial services industry are constantly looking for alternative ways to diversify their clients' portfolios. Since this strategy is not correlated to any set of economic indicators, investors have none of the concerns normally associated with investments in the equity markets. This powerful tool for asset recovery, estate planning, and charitable giving should be in every financial professional's repertoire when dealing with their clients. The secondary market for life insurance policies, known as senior life settlements, is poised to go mainstream. Are you ready? For further information on life settlements, refer to the following third-party articles, which include excerpts from the Wall Street Journal, the Wharton School of Business, and Time magazine.